If you have a small trading account and want to grow quickly, options might be your best bet. In this video, I'll walk you through an easy three-step strategy to do just that. I'm Seth Freudberg, the head of options trading here at one of the top proprietary trading firms in the world, where we have numerous traders earning 7 and even 8 figures per year. You found the right place to learn. Many of our subscribers and followers on our YouTube channel are trading with small accounts, and you realize that to achieve your goals, you're going to need to increase the size of that account so you can start trading with substantial size ultimately. And you might have heard that it may be easier to grow your account through trading options, and that in fact can be true, but you've got to use the right strategies to achieve this. And so in today's video, we're going to be teaching you a really easy strategy that can have excellent results once you understand its details, which simply involves taking 3 easy steps, which we'll be teaching you in this video. And so if that sounds of interest to you, then stick around, because I think you're going to be pretty surprised at how effective this can be. Before we get into the options trading technique that we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. And if you click the video appearing on your screen now, it will lay the groundwork for you to understand the option strategy that we're going to be teaching you in this video. Then when you're finished, you can come back and watch the rest of the video. As many of you may already know, the RSI indicator is a market momentum indicator that is used by people employing technical analysis to identify when a stock or an index is overbought or oversold, and therefore would be a solid long or a solid short, with oversold assets considered to be solid longs and overbought assets considered to be solid shorts. And generally speaking, an RSI reading of about 30 is regarded to be oversold, and a reading of about 70 is considered to be overbought, and can signal that soon that condition will reverse, so that what's been selling off will start to rally, and what's been rallying will start to sell off. So for example, let's head back to just about exactly a year ago, September 26th of 2023. And as you can see, the SPX index last year started selling off in late July and had dropped to 4273.53 by September 26th, which, as you can see from the RSI indicator reading below the price chart, that hit a reading of 30.319, which, as we just mentioned, is regarded to be oversold conditions. And so, believe it or not, we've achieved step 1, which is to find a stock or index which is in oversold conditions according to the RSI indicator. Once you've identified an oversold situation, then we can move on to step 2. And let's show you exactly how to do that. So for the purposes of this video, we're going to be assuming that you have capitalized your account with $5,000 and that you're looking to grow that account. Let's go ahead and pull up an options chain about 60 days into the future from this oversold condition on September 26th of last year. And that's going to be the options chain that actually expires in 65 days, which is November 30th. And with SPX trading at 4309.37 right around the close, we're going to go ahead and sell 15 of those 4310 put options, which are known as the at-the-money put options, because we're selling them at a strike price, which is almost exactly where the index is trading. And then we're going to move down 5 points to 4305 put options, and we're going to buy 15 of those. And when we've done that, selling a put higher up on an options chain and buying a put lower down on that same options chain, when we execute a trade that way, we are entering into what options traders refer to as a put credit spread. And this particular put credit spread is sold at the money with the short strike right at where the index is trading, just as we've done here. And so now we've completed step 2 of this process, which is to place an at-the-money put credit spread about 2 months out when the RSI index has reached oversold conditions. Okay, so let's analyze the cash flow of this so you're going to understand why this trade works. And so starting with those 4310 put options that we sold, as you can see, we sold them for a price of $97.45. But remember, those put options pay off at a rate of $100 per point. And so you multiply that price by 100, and you sold 15 of them. And so when you multiply it out, it comes to cash inflow of $146,175 into your account. But then remember, you are simultaneously buying those 43.05 puts for a price of 95.70, which results in cash outflow of 143.550. And so when you net the two together, you actually receive $2,625 net into your account. And your broker will require you to have at least $4,875 in your account to execute this trade. And since you started out with $5,000, you would have had the funds to execute this trade in your account. And by the way, if your account size is even smaller, you could just cut the lot size down proportionally to fit your account size. And so, for example, if you have just a $1,000 account, then the most you could trade would be 3 lots in this particular example. And so it depends on your account size, how large you'd like to trade this. Okay, so now that we've taken the step 2 and entered into this put credit spread trade, we're going to move to the day that this option chain expires, which, as you'll recall, is November 30th, 65 days later. And as you can see, the index at first sold off a little bit more, which often happens when an index hits oversold conditions, which is why we give this trade 60 days to allow the oversold condition to fully play out. But then, as it so often does, the index bounces, and it bounced substantially, closing at 45.6780 on November 30th, the day that the spread expired. And so to analyze the outcome of this trade, you start with the initial cash flow of $2,625, and then you value each of the options at expiration, which is pretty straightforward because an index put option only pays off if the index closes below its strike price. And since the index closed 257 points above its strike price, we can safely say that that put option expired worthless, as did, of course, the puts we bought down at 43.05, which are even farther from where the index closed. And so that initial positive cash flow just drops to the bottom line as our profit. And thus, we've completed the final step of the process, which is to wrap the trade up once it has achieved a profit of at least 90% of the initial cash premium. Well, in this case, we actually received 100% of the profit because the options strategy expired so far below the index's closing price on the day the trade expired. And both options expiring worthless, we just go ahead and pocket that full initial premium. Okay, so let's start a tally of how we're doing here. And starting with the $5,000 that we capitalize our account with, we will add to that the $2,625 that we made on the put credit spread trade, resulting in a new account total of $7,625. Okay, so now we're going to move to the next time that the RSI had closed around 30, and that actually happened on April 19th of this year after the index had experienced a pullback that started in late March and was strong enough that by April 19th, the index was considered to be oversold, closing at 49.6723 that day. And so we again pull up an options chain that expires about 60 days later, and the closest one we could find is the options chain expiring on June 21st, 63 days later. And as you can see, SPX, after rallying off a bottom that was hit in October of 2023, began to bounce. And that bounce continued all the way into March of 2024 when it experienced a pullback, which by April 19th had resulted in the index hitting oversold conditions. And so at the close that day, we'll again enter into an at-the-money put credit spread expiring about 60 days later on June 21st, where we sell the 49.65 puts right about exactly where the index closed, and we buy, again, 5 points lower, the 49.60 puts. And that results in positive cash flow this time of $2,775, and your broker will require $4,725 in capital for this trade, which you can now easily do as your account balance is now over $7,000. And once again, if we move ahead to the day that this trade expires, you'll see that the RSI oversold indicator was really accurate this time, and the index started bouncing immediately, closing on June 21st, the day that this trade expired, at 54.6462, which is way above where both the short and long put options were located. So they again expire worthless, and we once again walk away with all of that positive cash flow from the beginning. And so updating our tally, adding that successful June trade results in your account now more than doubling to 10,040. Now, the final time the RSI flashed oversold over the last year was just a few months ago on August 5th. As you can see, when the SPX lost almost 500 points, dropping from as high as 56.69 in mid-July, moving very quickly down to 51.8633 on August 5th. And so we will again pull up an options chain nearest to 60 days out, which is the September 30th chain. And as you can see, this time we sell the 51.85s and buy the 51.80s, which results this time in 25.50 in cash flow and a capital requirement of 49.50. And while at the time of our shooting this video, the trade has not actually yet expired, we can nonetheless show you where we are on the trade. And because as you can see, the index had bounced hugely since August 5th, rallying more than 500 points by 3:15 in the afternoon on September 19th, only 11 days before these options expire, it should be no surprise that the put options are now worth a tiny fraction of what they were originally, with the 51.85s trading at 198 and the 51.80s trading at 195. And so when we close the trade, we'll just be buying back the short puts and selling off the long puts. And the way that this is calculated is that we take the original cash flow of that 2,550, we subtract out how much it would have cost to buy back the 51.85 puts, then we add back what we cashed in the 51.80 puts for, and the result is a very, very minor dent to the initial cash flow, resulting in a win of $2,505. And so wrapping up our tally for the years, you can see for the three trades combined, we end up with a final account value of $12,545, a 150.9% return on our initial $5,000 in capital, much more than doubling the account in a year. And so what I'd like you to take away from today's video is that options strategies can be really powerful and can potentially jumpstart your capital growth if you begin to understand how option strategies work and under what conditions they are ideal to apply. Of course, no indicator like RSI is going to be perfect, and you won't win every trade that falls into this category. That's just not how the market works. But if you begin to learn about option strategies and start to understand which market indicators work generally very well with which strategies, you're on your way to a successful options trading career and an opportunity to grow your account rapidly to hopefully become a full-time professional option trader eventually.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.